Picture this. 5 years from now, you're holding a check for $300 million. That's exactly what happened with my next guest, who went from 0 to 300 million in 5 years in the real estate portfolio. Join me and my next guest, the Kitti Sisters, how they talk about how they went from 0 to 300 million in their real estate portfolio, how they leverage reputation, relationships, and results, and they literally lay out the playbook on how to do the same. All this and more coming right now. Let's do this. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friends, the Kitti Sisters, Nancy and Palmy Kitti. The Kitti Sisters are real estate investors that have built their real estate group from 0 to $300 million in just 5 years. They've done it by structuring effective deals. They've saved their investors over $90 million in taxes. And so what this means is that the Kitti Sisters know how to structure deals that make you and your investors millions, and they're about to teach you and I how to do the same. So Nancy, Palmy, welcome to the show.
Hello.
Hey, Ryan.
I'm so excited to be on the show. I'm a big fan. And I love that you guys are making billions, not millions. We're beyond millions. Go for the billions.
We love you guys, making billions community.
Yeah, that's right. Thank you. I love your energy. And we've been so fortunate to have wonderful guests like both of you and many people who are out there just really making things happen. And the mission of the show is just to help people understand, like, hey, you can do this too. It's not simple, but it's not that complex either. And, you know, with your help and mine and many other people on the show, we're able to really help and be that lighthouse to the world on helping people to get their money right, all in private deals and in alternative investments. So I'm so excited to have you guys here. What you've built is truly impressive, and I can't wait to get into it. But before we do, let's talk to some of the beginners who are just starting out. You've been a beginner, I've been a beginner, and I don't know about you, but I've always wished to say, man, if I could go back, here's what I would do different. So with that being said, let's address the beginners on how do they win in the early days. What would you tell people? How can they get some early points on the board doing what you do in real estate? What would you say?
Yeah. So this is something that really, if 300 million in 5 years is a nice number, but I feel like we under index because we didn't get started earlier. So to say that like two people from a totally different field coming into from fashion to multifamily, if we can do it at that pace, like what we're going to be able to share, I think it's going to be very impactful. So in multifamily, what we view is there's basically five major categories that a general partner, like an active investor who's running the deal, they fit into. So it's underwriting the deal, sourcing the deal, having relationships with the brokers, being the asset manager, capital raising, and then like being the balance sheet person. So I can go through each one, what it means in general, and then I can dive into it with the order I think is important. So sourcing the deal, this is a person who loves a spreadsheet and like dives into financials, rent rolls, and like Ryan, you're probably one of those people. Probably have very.
That's why I'm laughing. Yeah, for those of you who are listening, I'm actually laughing. I was like, yep, that's me for sure.
Yeah, very complex formulas, all that stuff. It's like someone who's like very, very comfortable, almost like the Matrix. You see these numbers and like, I can see the big picture. It's not like for us, we came from the fashion world. So it was not a normal thing. We had to learn it from scratch. It wasn't taught in school. So that one I feel like have a very, very high learning curve. Not only you have to learn just Excel in general, but also you have to understand there's an art and there's a science behind underwriting. The science is the raw data that they provide you. Here's our financials, here's our incomes, here's our expenses. But the art is how do we finesse that so that it makes sense, where we're not overly aggressive and we're not just banking on future valuation, but like making sure that day one we buy this deal, it's going to make sense.
And in addition to that, like for people who don't live in landlord or investor business friendly state like us, it's really hard to understand or to have that market intelligence to know like the numbers, like what kind of number to put in those spreadsheets. So if you don't live in that area, it's really hard to become that number person. It's not impossible. It's just that you have a learning curve, a steeper learning curve.
So what have you done to counterbalance those that don't live in there? There's a steeper learning curve. How would you recommend people overcome that?
So multifamily is a team sport. So for us, we always recommend, like even for us ourselves, if we're to invest in any state, we want to have like people who live in that city, like or around that city to partner with. For example, we own in Houston. So one of our partner lives in Houston. So we are doing development deal in north of Dallas. So we have a partner in Dallas, and then we have a deal in Atlanta, right? So we have people who like can fly there within like an hour or could get there within an hour or 50 minutes of either flight or drive time.
Yeah. So that's one way. So you have a partner who's basically boots on the ground, who actually understands the market nuance. And in real estate, block by block, that can totally change the surroundings. And we kind of talk a little bit about like us living in Los Angeles, and like from Culver City to like south of Culver City, very different dynamics. So even if you think that you're doing a 1 mile radius, like this is a great area, income strong. It's probably not a perfect circle. So someone local, the other way is this takes more work, and they've like some people have done it where they live in Los Angeles. They'll drive to Phoenix, for example. I think it's a 10-hour drive, and they'll just live there for a while. You have to, for example, if you want to invest in Scottsdale, Arizona, you basically create a grid and you map out all these apartment complexes that fits into your buy box, and you walk them, you tour them. They call them secret shopping. You go every single one, you jot down the amenities, you jot down what pricing they're offering, what are their vacancy, what are the things that are there sizzle features, and you map it out. We use Google Map to do that. So it's like layering. So we can see like, okay, these are properties that were purchased. These are on market, and this is the price. So we have like a sort of like a database of us. We can see like, okay, surrounding area. This is the pricing. Once you do that, you have a map. Anytime a new property comes into the market that's available, you can see like, okay, I have like 5 properties in the vicinity within 3 to 5 miles that I can compare it to.
And the next one is you actually have to have a great network, meaning that if you have friends who's buying in that area, like for example, when we were buying our Houston property, like one of our partner actually bought a property like across the street. So we have all the data. So as he was reviewing our underwriting, he's like, oh my God, this is your projection, but we're already achieving it right now. So this is totally conservative. So our tip would be like, either you partner with someone or you actually walk the whole toward the area, or you actually have friends who's buying in that area or already owning it. Yeah.
Brilliant. So it sounds like understand your buy box, build out a grid, really understand sourcing the deals, but those tactical strategies are phenomenal. So, it sounds like you said we got friends in different areas and all that. You mentioned that the second area of those 5 components of a good winning start in real estate, second one was relationships. I wonder if you could unpack that a little bit, because you're kind of dancing on it anyways. Let's really open this one up. How important has relationships been, and relationships with who?
Yeah. So this is actually the relationship with a whole bunch of different players. Like in multifamily, we don't have just partners as general partners in our deal, but we work with a lot of vendors that we have to trust. It starts out with a broker. In multifamily, we have one broker on both the buy and sell side. So therefore, that one person technically represents the seller, but also we're negotiating through mostly him. There's a few women, but mostly him. So I'm just going to say like we negotiate through him. The other very important is a property management company.
Really important because they're doing day-to-day operation, right? So while we're living hundreds of miles, thousands miles away, there are the people who actually have to go to the property and report to us on a weekly basis. Like, hey,
they're managing it, right?
Yeah. Are we hitting our projection? Are we doing what we target to do our business plan?
Yeah. So SEC attorney, real estate attorneys, real estate attorney, as we're negotiating the purchase and sale agreement with the seller, it's not boilerplate like single family homes. It's very complicated, and you need someone that you can trust. This is a lesson. So one of the property we negotiated a purchase right during COVID, at the beginning of COVID, and we thought we were smart, and we had a clause in there that says like, hey, if we get I don't remember the specific, but basically we thought we had an out at some point, and then our attorney reviewed it. And then that day came and we're like, hey, do we still have an out because of COVID? And then we learned like, no, it was not there. Like they gave us something that looked nice, but it turns out that attorney like totally outsmarted ours. So like that's that we don't use that SEC attorney anymore. Our real estate, it was a combined, but basically we don't use that firm anymore. So those kind of stuff happens on the SEC side. Obviously, like our business is highly regulated. So we have to make sure that the paperwork, the operating agreement, the subscription document are really solid and keeps everyone safe. So
and then like the insurance, the water conservation, like all of these are like partners that we work with to put together a deal.
But like the most important one, to circle back to your original point, is the broker relationship. We say this all the time, multifamily, it's an unfair business. It's unfair because just because you have money and you're new to the area, they don't know who you are. The brokers aren't going to take your offer seriously, because if we came in, they know we've executed several times on substantial deals. They know that we don't ask for, it's called retread, but we don't ask for credits. We don't extend deals. We don't make it difficult to close. They're going to be more likely to advise their seller, like, hey, go with them. And the story here is like, we started out our first property that Nan said in Houston. We didn't have the relationship with a broker. We have a good friend who's bought close to probably almost $1 billion worth of property in Houston. He's very big down there. So I called him up and I said, hey, do you know this broker? And he said, yeah, we're really good friends. I said, can you put in a good word for me? And he said, yep, I'm going to give you street cred. I'm going to give the Kitti Sisters a street cred. And then like he called him up and he's like, hey, they're serious buyers. And at that point, that property, we bought it. We ended up buying for $68 million. Prior to that, our highest was 40.5. So it's a big jump in terms of raise, big jump in terms of dollar. But he gave us the transfer of authority and like the trust that like, hey, we're going to be able to do this. We closed on that property. Then we went out and we bought another property from the same brokerage in Arkansas. That became $77 million. So now the Houston broker gave a call to the broker in Arkansas. Same thing. Hey, they just closed on this deal.
They just raised $34 million on this deal. Yeah. And this is a $38 million raise. It's just $4 million more. Yeah. They can do it. And we're like, yes, we can. And that was just like 3 or 4 months prior to us closing down that deal.
Yeah.
Brilliant. So it sounds like when you have reputation, relationships, and results, the 3 R's that we follow on this thing, you were able to not only leverage your reputation and your relationships. So you had a reputation that was extended through your relationships to say, hey, the real players are not going to waste your time. They're great operators, which is code for great asset managers, which I know is the third thing that you mentioned for having a very good start, is to say, be a great asset manager, not only in the fact that your numbers line up and all the accounting stuff that happens. And yeah, that's important. But I think more importantly, you mentioned the word street cred. And so being a great asset manager is more than just managing the asset well. It's being known for managing assets well. That's important. And so you were not only good at managing assets, but you were also known for it. And because you were known for it, that opened up more opportunities, which took you from that one deal and allowed you to jump from, I think you said 40 to 64, something like that?
68.
Exactly. So you can see that although the numbers were big, what most people, and this is the part I don't want to skip, is that for those of you who are listening to the sound of our voices, the thing that, from my perspective, you keep me honest, but the thing that allowed you to cross that bridge to the next level, because in this game, it's just nothing but infinite levels. There's just new levels to as far as you can go. And so bridging each level, and disagree or agree with me, but what I've found in my career, and I think you'll agree, is every time I've moved to the next level, it has been through at least one of the 3 R's, reputation, relationships, or my results have allowed me to enter the next level. Have you found the same?
Yes, definitely, Ryan. And for those of you who just start in this multifamily journey, don't be scared, and don't think it's impossible, because you don't have to be great at everything. And it goes back to one of the R, which is relationship. And you just have to learn how to add value to the team, right? There's 5 buckets that Palm is going to go over with, or you kind of briefly mentioned. And then if you learn how to add value to the team, like with one of those value, with those, assets that they need, that's how you're going to jumpstart your journey. Like you don't even have to start with like a $1 million property. If you learn what the $40 million people want, and you can serve them and you can help them, then that's the way you can, be on part of their team.
I think like that's the right point. Like as a beginner, you may think, oh, well, Palmy and Nancy has a reputation. They have the relationship. They have the results. How can I be that day one? Well, day one, we had nothing, right? We came from the fashion world. But what we did was, because it's we're never the solo GP on any deal. We always have people who's in these deals with us at the very beginning. They were like the senior partners, and we piggyback off of their relationship. We piggyback off of their reputation and their results, so that we borrowed those credibilities, and we were very honest with the people we're raising money from. We're new to multifamily. We're not new to business. And so there's a lot of transferable skills. So people who are either like, you're an employee, you have skills, you have a lot of skills. Don't discredit that. Bring that to the forefront. Let people know. But more importantly, hey, my partner has been doing this for 10 years. We have these kind of results. I'm not doing this by myself. It would be ludicrous to do that. So know that like the 3 R's, and I love that when you mentioned that, and I told Nat about it immediately. Like those 3 R's carries over to any business. If you can do that, you'll be fine.
Yep. Those are this is what I teach. I have a course in fundraisecapital.co, but many other things as those of you who followed know, I've helped over 2,000 people launch their own funds. We've done a lot of things, and this isn't me beating on my chest. I'm just saying, a lot of you probably heard this before, which is those 3 R's. And what we say is, although reputation, relationships, and results are good and they rhyme and all that stuff, the important thing is you have to see them as an asset. And I remember in my early days, just learning about finance before I even went to school for it, is I would read it from Robert Kiyosaki, right? A lot of people know who this guy is. And I remember him just saying very simply, an asset is something that puts money in your pocket. So if you see reputation, relationships and results as an asset, how are you managing those assets? If they are literally the most valuable assets in your possession, how are you leveraging those to put money in your pocket in a safe, ethical, and in a way that you can look at yourself in the mirror and maybe your spouse and your children as well, but making sure that you manage reputation, relationships, and results, I would say also might be a stretch, but it might tie into being a good asset manager. So that's number 1, 2, and 3. What about 4 and 5?
Yeah, capital raising, right?
So that's exactly when we first got started. We quickly realized that the number one skill that experienced team wanted was the ability to bring money to them, right? The ability to help them close the deal. And that's why we feel like capital raising is kind of like it's a quickest path to onboard to become part of the experienced team.
Yeah. It's like when we first started, we talked about it. We couldn't underwrite for anything. Like
We tried, and it was,
even if I can punch in the numbers, I don't know if they're correct. I wouldn't trust myself with millions of dollars worth of deals. It's not like a little $200,000 duplex or something, right? We're dealing with big money. So none of those things, like I don't know how to asset manage. I don't have the relationship with anyone. No one knew.
and we don't live nearby.
We live nowhere near that. But what we knew was, and at least we felt, we live in California, we live in LA. We're like, we know we can get this, right? So it wasn't easy. We didn't do it correctly at all. But we did discover that it opened so many doors. When you started telling people that, hey, I can be the person that can raise money, people want to tell me more. Because keep in mind, when we first started, 2018 and then 19 we bought, the price of the properties kept escalating. Like when I first started, we were hearing our peers buying things like 6, 7, 8 million. That was a lot. And to fast forward to today, where we're buying something that's like almost 100 million and it's leveraged at 50 something %, that's almost buying like $100+ million property. So
in a good time.
In 5 years, that's happened. So the need for capital is only going to escalate. Prices aren't coming down in the long term.
And I think when people first get started, they want to do something that they can control. And they think that underwriting is something that, hey, I just, have some deals to start underwriting and punching a number. That's something I can control. Versus like them talking to other human and making that connection because they're like, oh no, I don't want to ask them for money. But we all know that raising capital is not about asking people for money. It's actually, we're in a position to help them grow their wealth. Mm-hmm. So it's not like we're begging for their money.
Yeah, it's almost like, and some people might agree, they might disagree, but one perspective of this is it's almost like a job interview, but not exactly that much of a power difference in the thing. But what I mean by that is you're essentially, when you're pitching investors, a lot of the time you're mentioning them to say, look, you've got a problem. I can make this problem very simple and solve it for you easily. So you don't even have to worry about it. And by the way, when I solve the problem, you're going to make a lot of money. And I might make some on the side as well. But the important thing is you have an issue, whether it's you don't have enough money or you're having a hard time growing it, whatever that might be. So you're offering solutions that are not complex. I mean, they're at least how you present it. It's very simply explained. Now, I find that a lot of people, when it comes to raising capital, this is something I'm known for, but when it comes to raising capital, I know a lot of people who are starting out they always tell me that they ask me this question, Ryan, like this is literally my first deal. For those who are at that phase when I talk to them, that's not many. I usually deal with people a little further along like yourselves, but for people who are starting out, I see you out there. I know you're out there. You're listening to the show, but so I really want to address them, and we've all been there. They say, are investors really going to take me serious if I really don't have a big track record? If I had never done a deal before? And I was like, everybody that's a billionaire did their first deal, so yeah, you're going to be okay. But that's just placating them. The real what they're asking for is strategy. So I obviously have an answer to this, but I'm curious from your perspective, what have you found that really helps you get credibility with investors when maybe you don't quite have it at the level you had hoped? Like a beginner, what have you found that has helped to add credibility when in your early days, if you can remember that?
Yeah.
Well, first of all, I think like when we're trying to solve people away from we're not leading them to our pressure, but we're actually getting away from their pain,
helping them moving away from pain. So there's this book. So basically it talks about like people, if you're leading them towards pleasure, they're going to want to see your credentials, mm-hmm. all these things about like who you are. But when you're leading them away from pain, they don't care how big your company is.
And there's a story to this. Like if you're,
so here's a story. Okay. Ryan, you're at Staples Center, right? You're like excited. The Lakers are playing. You're like, oh my gosh, we're ready to go. So you're chatting on your phone and you're just walking. You see a guy in the corner and he's like, I have some money. Like
I have $100.
And you're like,
who wants it? Right?
And you're like, okay, so a couple of thoughts comes into your mind. You're like, first of all, why would you be giving me 100? Second of all, are you trying to kidnap me?
Are you trying to knock my head?
Third, are you like trying to like skim my credit card or something? Like something is iffy, right? Like this guy, I'm not going to be near him. And you're texting. You're like, hey, buddy, where are you? You ran, bam, into a pole. Blood's now falling on your face. You can't see. You're like, oh, what's happening? Delirious, this dude runs over and says, here's my dirty snot rag. Let me use this to stop your bleeding. Are you going to take it? Most likely, because you're like, and then he's like, I don't have a phone. Do you have a phone? Like, give me your phone. I'm going to call 911 for you.
So you give your phone, you give them the password.
You give them the passcode, you take it. And that's and that's the point. When you're in pain, you don't care. You don't stop to ask what the person, like their credentials, who they are as much, because you're burning up inside right now. And like for us, because we realize that capital raising is a human relationship. We love automation, we love CRMs, but it's a human business. So you have to understand that person's pain and obsess over their pain more than they know, more than they've thought about. And so if you can articulate their pain, you will gain automatic credibility with them. And so that's like the starting point.
I love that. That is so good. They will not check you on your or they might, but they're not as concerned about it because you've pivoted away from, oh, we're going to make you this money and you're going to be a billionaire driving Rolls Royces and all that. They're just saying, look, you got a serious problem, and unless you change, you might get wiped out. And they're like, wait, what? Tell me more.
A lot of time, like when we raise capital, we don't go to them. We actually get them to raise their hand and say, I want to invest with you. How can I hear more? I want more information. And that's why like they don't ask us for credential. They actually want to invest with us because we have done a great job at helping them, being the person that they know that they can trust, that we can lead them away from their pain.
So like, we're not saying to be inauthentic. Like the most important thing is day one, you have to be authentic. If you're new, you're new. You have to tell them. Like we said, like when we first started, we're new, but you leverage your partner's reputation and results. But if you can articulate their pain ahead of time, have them raise their hand and say, hey, can you tell me more about what you're doing? It's so much easier. That conversation becomes, now the interview is, I'm hiring you. You're not hiring me. And so when we go on a phone call, because we do 506B, which is basically we have to have a pre-existing relationship before we make an offer, we hop on a call and we tell them ahead of time, look, the purpose of this call is to help you understand for potential like multifamily, if this is the right vehicle for you. If it's not, we'll let you know. If it is, let's see if it makes sense for both of us, because we also are very selective of who we let in our deals. And we've told people like, we don't have a specific blacklist, but in our minds, we definitely have people who are not going to take money from. You're
spot on. Often you talked about maybe leaning on the credibility of your partners. And so often a strategy, if you're not quite there yet, what a lot of people do who are effective, and we talked about moving to the next level, and they do it quickly, especially if your next level is literally the level 2, is you get a board of advisors, or whether it's formal or they're your partners or board of advisors, there's some way affiliated with the fund. Because often when you're pitching investors, what I found, and maybe found something different since we're talking about raising capital, and often when they be like, oh, I don't know who this Ryan Miller guy is. I've never heard of him, but he's got Ray Dalio, Ken Griffin, Warren Buffett, and Joe Rogan, and I don't know, Jocko Willink. I don't know, anybody. I know who all those guys are. I mean, look at the eyeballs that are on this deal. Like, I'd be an idiot to pass on it. So that's a very effective strategy. And some people do it for free because they're retired and they're at that phase where they're like, I don't need the money. I'm just happy to help the next generation. But getting an advisory board is another way that you can rent the credibility of somebody else just to prime the pump to get you started as you're also building your own reputation relationships. So that's number one, is the optics. But also number two, those people are going to guide you. And there's never a more important time to get some guidance than in the beginning when you're raising capital. So anything else you can add to that?
That's actually really great. And I noticed that as well. As we ourselves are scaling up, we're always people who are always wanting to learn more. And so therefore, just that I already embedded in my head. Okay.
I think like as entrepreneurs, we always like once we find a solution to one thing, we run into a next problem. And it was always continuous learning. And that's why we love this game so much, because it keeps us moving along. It's not like, it's never like about making money. It's about making impact for us, right? And income just follow impact.
Yeah, absolutely. And I firmly believe you do not have to give up income to make an impact, or you don't have to give up your purpose to make a profit. Absolutely. Those two can coexist. They do coexist, and more so now than ever. And I couldn't be more happy to show that this next wave, I would consider us in that next wave of investors in the economy, is we're saying like, hey, yeah, obviously make money. We need profit. That's what keeps us around. That allows us to hire people and create opportunities. But I'm more interested in doing it in the right way where I'm like, I can like really feel good, not just about the money. Sure, that feels good for a bit, but it can be fleeting, but really feel good about the impact that all of that work that went in to be, even if it's like the most beautiful property you've created, but you're saying, look at the difference before I came into this neighborhood to after, or before I helped this startup to after, or before I did this hedge fund versus after. Look at the impact I'm making. Look at the people that I'm affecting. It is literally the greatest feeling. And that is why I do what I do. And I'm sure it is for you as well. So that being said, I know we're saying how to get a winning start. What would be number 5?
Yeah. So when we buy these large properties, the biggest player in the capital stack is the lender. So right now, leverage is probably around 65%. When we bought the $77 million deal, I think our leverage was like 50 something percent, almost 50. So the deal had to really pencil, right? If you're going to do such a low leverage. So the raise is higher, but also the amount of money you're borrowing is still high. So the loan on that was 44 million. So the largest partner in the loan is the lender. The lender, depending on who they are, will require net worth and liquidity. So net worth is typically the amount of the loan. Liquidity is 10% of the borrow amount. When you're first starting, a lot of time, obviously, that's not a small amount. Sometimes, like if you're new, you may almost like the board of advisor thing, right? And so basically, you invite someone more seasoned, maybe they're semi-retired and they want to help the next gen. Hey, would you mind coming on board as a GP? We'll give you a split, but you don't have to really do anything. You may advise us from time to time if you run an issue, but primarily we're borrowing your balance sheet. Your balance sheet meaning your personal net worth and liquidity. That when they're doing their due diligence, the lender is doing their due diligence, and we're like, okay, check, they have enough. Brilliant.
So bringing on the balance sheet partner, and in fact, there are some lending products. I had a show about that a couple months ago where that was one of the products. If you don't have, he was a private lender, but there was a product where they were able to offer, basically had billionaires that they would lend their balance sheet to the deal and they would just get cut in. I was like, oh my gosh. But when you say it, you're like, how is this not more obvious? But that is a big problem. And that's, as entrepreneurs, that's what we do, is we solve problems. And so by providing that balance sheet or some assets that you can lever against or lever with is absolutely key in raising capital. You got to get that capital stack right. And like you said, if you don't, the deals are really, you got to have a real sharp pencil to make some of these deals work. But if you got unlimited funding, both debt and equity, there's no limit to what you can do. I absolutely love that.
A lot of these people, like the people who come with the balance sheet, they actually want to be in multifamily or in the game. They just don't have the time, the energy, the know-how, but they know that they want to put their money, they want to make money. They love the idea of making money, right? So for them, they're like, oh, I want to have someone who actually work for me.
It's almost like a passive active investor kind of role.
Yeah. And they're on calls, they're still participate, but they're more of advising more than doing a day-to-day activities.
Brilliant. Just getting early points on the board. Those top 5 categories are absolutely brilliant. Thank you for that. But you know as well as I do, upside is just half of the game. The other part is you got to cover your downside a little bit. And especially if you're a beginner, there's a lot of blind spots and you don't know about them. That's why we call them blind spots, because you can't see them. But we're all here to help expose a little bit. So from your experience, what are some of those pitfalls that you can avoid in the early days? What would you say?
Yeah. Okay. So the first one is being overly optimistic about your income and your expenses, because sometimes you think like, I can keep raising rents, but you're not pulling data on the submarkets. What are rent growth numbers looking like? So we always get supporting third-party data just to validate what we think rent growth can be. So it's either CoStar, Yardi. There's a couple of different providers. It costs probably like $1,000 per month subscription or something. If you're new, you don't have to subscribe. Your broker, your mortgage broker, or even your teammate, your lawyer or your teammate, someone typically has access to it. So don't feel the pressure to go subscribe to something that expensive, but definitely use those data to validate. Again, when I talked at the beginning about scouting the area, doing the grid, part of that is punching in these financials from all these properties. So now you may not be buying it, but you now know like property A, B, and C, these are their financials. This is their rent growth. So you can compare it against, like, use historical data to compare it against what you think your performer can be. So that's the first one. So like, as far as underwriting, make sure you can validate. Also, check with the property management company. If you're going to hire a property management company, they need to confirm that, hey, I feel like you're in line. You're not too aggressive. And the property management company should be someone that is local to that submarket, not market. So specific area of Scottsdale. So I'm not like, hey, Phoenix Metro. I want that specific locale because I need them to be managing assets in that neighborhood, in that specific asset class. So if I'm buying A class, 2000 or brand new construction, I need to have a property management company that are experienced with that product. So check with them, make sure it's valid. On the underwriting, the other part is, we always do sensitivity tests to check for downside against historical worst case scenarios. And this could be macro historic, like worst case scenario interest rates, or it could be property specific if we have that data. So things like, what is the worst economic vacancy that this property can support to break even? For these type of products, the banks consider debt service coverage ratio of 1.25. So $1 goes to the bank, we need to have 25 cents in our pocket. So that's like a safe number or higher. So you just run your data, you run your underwriting, and you push that number as high as possible to see how close you can get to 1%, 1.0 DSCR. So if economic vacancy on most of our property is like 50%, meaning if 50% of the people stop paying rent, they live there, but they stop paying rent, we'll still break even. Or if we stop raising rents, increase expenses, to like what extent are we still fine? So like we always run those data, and those are also part of the reason why people are comfortable investing in our deals, because they always tell us like, Palm, I love that you have these worst case. What is the cap rate? Today's when we buy some property, maybe the cap rate was 3%. What if we are wrong? What if it expands? Like what happens if cap rate is 4, it's 5, it's 6? How are you preserving my wealth? And a lot of time it will go from like 2x return, it may go down to 1.4. And if I'm being talking too much jargon, just I know you know, but like I don't know.
I'm following you.
Okay, so basically, like if you're doing like a 1.4x multiple in a worst case scenario, most people, because everyone, I think like fundamentally, yes, we want to make money, but fundamentally we don't want to lose money. Wealth preservation is key. So if I say, do you think, what's the chances of this property being A class going to jump to 7% cap rate in 5 years? Scenario is not likely. But even then, you'll still exit at a 1.4, meaning you put in $100,000, you get out 140,000. You still feel safe. Nothing's guaranteed, and we always say that, but those are the scenarios that we always run with our investors.
I think we're in the business of actually helping them like de-risk their investments. And I think that's really critical for us when we present a deal. We don't talk about the features, the benefit, like, oh yeah, you're good. This is the projection you're going to make. Like we kind of mentioned it, but the key here is to mention, how can we help de-risk your investment? Like what are the ways that we're doing?
Yeah. And that also goes to the asset management part, which is critically important. When we first started, the rents were just jumping 10, 15, 20% annualized. Like Phoenix was 20+% for several years in a row. That's not the case. Today, operational excellence is so important. So if we can emphasize our ability to manage these assets well, it can give them peace of mind, because people like maybe in Wall Street, maybe in commodities, things are the same. You buy corn, it's corn, right? It's a commodity. Multifamily, it's not a commodity business. There's 3 risks. There's asset class risk, there's the property risk, and there's the operator's risk. So if you believe multifamily is a safe asset, that checks one off. If you believe A class is a safer alternative than A, B, or C or B, then that's a nice thing. But more importantly, it's a jockey. Who's going to manage this thing for you, right? So if you have those utmost trust in this person, the other 2 things are things that are solvable. You can have 2 identical properties and one person who pays attention, who actually knows how to manage this, knows when things are going well, no problem. What about the problems? Every single day there's challenges that comes up. How do we solve for it? That's the key.
Brilliant. Now, I know you mentioned about getting the right assets as part of your risk management of covering your downside. Now, I know you guys, for the most part, do a Class A, but it wasn't always that way. Maybe you can walk us through a little bit of why did you make the switch, and why is Class A the right asset in your opinion? And maybe walk us through that whole evolution.
I think when we first got started, Class A was really out of reach, because Class A means bigger dollars, bigger raise. So for us, we were kind of introduced to Class C because we're like, oh, this is a
$6 million purchase versus a 20. And also like at that time, cap rate wasn't as compressed.
Yes.
So there's value to buy C versus A. But as cap rate started compressing, it's almost the same cost per unit. So why would you not go automatically to the better asset? Also, and this is no knock on gurus who teach apartment investing. I think they're saying something that the new people want to hear. Go buy C-class assets. It's value add. You can see a simple picture. You think about transferring from single family flips, all these, the dirtiest, the ugliest house on the property. And
it's cold.
you can imagine that, right? It's easy to teach, but it's not the truth. It is not. Like, in my opinion today, that is not the case. I just talked to my friend who's like entrenched in C, and he's basically trying to get out of the business. It's like horrible. When we got into our C property, the property we bought right after COVID, right during COVID, almost immediately the property manager's car got burnt on site. Like she emailed and said my car got burnt. We actually had to buy her a new car because we felt bad. Then she got threatened that people wanted to beat her up, so we had to we had to build a box so people can drop checks without coming inside.
Then we had to get her a security guard.
Then we had to get her armed security guard because people were, and it's Texas, so you're not allowed to have firearms on property, but people have guns. So we actually had an armed security guard walk with her when she needed to serve like eviction notices and stuff like that. We had to hire a patrol. Like all our expenses went to like patrol. I think it was like $4,000 or $5,000 per month just to have someone drive there at night. That time we were able to increase rents. Today, with high inflation, with higher interest, with a lot more purchasing power pressure on like grocery, gas, credit card bills, those people in the C class are workforce housing. They're like minimum wage worker. They work retail. They can't afford rent increases. So for us, if our business plan is so simple as increase income, reduce expense, inflation has increased expenses. We can't push up income.
So they can't afford to pay us
what we need to make this property profitable for an exit. Then that's worthless. On contrast with our A-class property, which is, I feel like right now our A-class in Arkansas is our crown jewel. It's like an A-plus class. That one, since 2021, since the seller built it, it was from the developer, they've only had one eviction, including our time there as well. We have about 99% on-time payment. It's in the right market that's growing substantially. We have like 180,000 median income in the neighborhood. Mm-hmm. Billionaires literally live next door. The seller, who's a billionaire, she lives basically in the community right behind our building. So like those are some of the things that help really. So the asset itself is important in that case. Like, you know,
yes,
that's why we avoided C.
Yes, and as we move up from C to A, we realize, like Palm just mentioned, is that the tenant profile is totally different. The affordability is totally different, and then the ability for us to achieve our business plan is totally different. A lot of our investors who's like, how can you help me make money in A class? They don't understand. It's like, wait, it's brand new. There's nothing to value add. It's actually because they don't know.
So there's a couple of things that are easy value add in A class. The first one is it could still be under market rent. So keep in mind, like when we bought this property from the developer, their key was to get it occupied, right? And so they may have not pushed rents to the maximum because they just wanted to fill out the units and then refi into like agency or sell to us, right? Because we want 90% plus occupancy. Or the other thing is, in our case, that market was growing organically at like 13% when we're buying it year over year because of the market. Today, even when things are slowed down, we just had the meeting with our property management team. It's a 5% year over year organically. And on top of that, this specific scenario, you look for value add where like we had 18 retail triple net leases that's on the bottom floor of our apartment complex. When we bought it, we had about 4 units occupied. So we had 14 that were vacant. So right now we have all the units leased up or have LOIs for them. We basically, Ryan, increased our property's value by $20 million.
Wow,
just in a couple months.
9 months.
Yeah.
So from January till now, because we had to switch brokers, or 8 months. We had to switch brokers in between. But basically, during that 8 months, the value just increased by $20 million.
Wow, good for you. I could see why you are the Kitti Sisters, the famous legendary investors, and why they come to, but in all seriousness, why investors even come to you is because it's you've got reputation, relationships, and with 20 million in 8 months, you got results. So you can see how you just start spooling this up. This is amazing. Thank you for talking about how to get some early points on the board, how to reduce risk. Now, the other area which does tie into both upside and downside is the ultimate market. So I'm just curious, maybe you can walk us through, and our listeners around the world, what are you seeing in the market? And then maybe we'll jump into where you think the smart money is going. But what are you seeing out there?
Yeah, originally I had expected more foreclosures, to be honest. I thought there would be a whole bunch of like fire sale, and I was really looking for it. Okay, so I want to clarify. I'm not happy that the investor, that are existing on that deal lose money, of course. But if it's already foreclosed and someone needs to take over the property, I think like it's an opportunity in the market. So 2 separate things, right? So I'm not like wishing people to lose money, but I had felt like the property value dropped about 20%. from 2020's peak. And it wasn't because of the fundamentals. It wasn't because of the property's operations was bad. It was because of the interest rate, primarily interest rate. We saw when we bought one of our property, it jumped from 3.35% to about 8.6% in 2 years. So the debt service is skyrocketed, right? So it sapped away any cash flow on the property. That means that when we're trying to go out to sell, we can't sell for the price we expect because our NOI, our net operating income is lower and their interest rate's higher. So the buyer, they can't buy it. They can't afford the price that we need to sell it for to make a profit. I don't think that's the case anymore. I think that it's a great opportunity to start buying multifamily right now. Residential properties in the United States is still at a shortage of like millions of units. And because of the high interest rate, construction loans actually pause or halt. And that means that in 2025, 26, 27, things that were in the pipeline to come online will not be online. And that means like for the stuff that are online or the new things that we're building, like we have 118 townhomes that will start coming online June of 2025 because we didn't have
north of Dallas.
Because we didn't have debt on it. We just had equity to do the construction. That's going to be stuff that people are going to gravitate to, and the other stuff is going to come way later. So supply and demand imbalance, there's a lot of affordability issue. Home prices, unfortunately, people think, hey, mortgage rate drops. When mortgage rate drops, I'm going to be able to buy a home. It's not true because there's a whole bunch of pent up demand for properties purchases. It's only going to go up in price. And so unfortunately, the United States will become a nation of renters. And it's up to people like us to provide those affordable homes that are in good quality, not slumlords. And so to turn that scenario into like, hey, what's the best case for you? Then, okay, let's build these BTR, build to rent communities, these townhomes so that you can have like a place that feels like your own home without having the burden of a massive mortgage.
And the fact that we're building a community, we actually go out there and ask the third party property management team, like, what do the tenant likes? Like, what kind of amenities do they want? So we actually built based on their desire, like, for the most part, because we're building exactly what they want. So they're willing to pay us premium to rent it.
Stuff like pickleball courts, EV outlets in the garage, dog grooming stations, a massive pond, like this kind of stuff that you feel like is like community kind of.
That's brilliant. And so what cities are you seeing right now that are some of the hottest cities right now? So
right now, based on like basically when we buy, we're looking at cities that have a really diverse economic base. We see that cities have like a net migration into the area, have well-paying job, like white-collar jobs. So, for instance, the city that we're building, the townhome, it's north of Dallas. So it's like the highest growth area in North Texas right now. And part of that is because the PGA Tour moved their headquarters there. Universal Studios is building there. Toyota has a plant there. There's a whole bunch of Cowboys. The Cowboys. Texas Instruments there. The Cowboys have a practice facility there. So you have to see what is in the surrounding area. And we have to also forecast. So we're forecasting that this is a path of progress. And so like that kind of market, if you can research that, you'll be fine. And the real estate market doesn't move as fast as like the stock market. So it takes time to build out. So you're going to be safe with a lot of the information that's out there. I would say Dallas, north of Dallas would still be really good. Houston's really good. Atlanta's really good. The Carolinas, very strong. Florida's amazing, except for insurance. And it's starting to come down. So if you can handle the insurance piece, Florida's a phenomenal market. A lot of net migration to the area. Orlando, Tampa had the highest rent growth for like several years. Phoenix is a little bit overpriced, but it may come down. So if you were looking to Phoenix, I would say look at Tucson, Arizona, which is a couple hours south of there. So those are some of the markets I think like in general, like MSAs that are still phenomenal. Do not invest in non-landlord friendly states. So this is California. Don't do that. Washington, Illinois, New York, very, very blue states are going to be really difficult. And we're pro tenants, but we're pro tenants who pay rent because this is we are a small business, right? We're not the government. We can't subsidize people's housing. So we have to make sure like if you sign on a contract that you're going to rent something and you agree to the terms, you agree to pay us $1,000 a month for the next 12 months, unless there's a really justifiable reason, you better be paying that. And that means like we'll work with you, we'll find resources for you, but if you don't pay and you're playing games, we have to have a way to evict you.
Yes, because we have our duty to our investors, right? Like we are managing their money. So we have to look out for their interests as well.
Right. Because that can harm your reputation and your relationships and obviously your results as well. So managing that, you can see it always comes back to those three. And so you do have a duty to your investors who are trusting you. Even like obviously there's legal and all that stuff, but just from a moral being a normal person, somebody gave you a lot of money, which was ultimately they gave you trust, right? You don't know how hard it was for them to earn that dollar, and just to hand that over is no small feat. And so we talked earlier about raising capital, but appreciating that is a lot of work to get it in your hands, and it was a lot of work for them to get it into theirs. And so when that trust is established, I know, and just talking to you, and I've gotten to know you girls for a while, you do take that as almost a sacred responsibility, that when investors trust you, it's trust. It's not just the capital, it's the trust that we're preserving. So good for you on doing that. Now, it's not enough just to know what's going on, but just, this is not financial advice, folks, but just in your opinion, where do you think the market's going?
We're in the buy mode. We just talked to our partner this morning, or like we're buying, and it's not just multifamily. So what we're really bullish on is BTR,
which is built to rent.
If you Google, anyone can Google right now, all the institutional investors are so bullish on it because they hadn't been in it. This is almost like, today is like 2010 for multifamily. If anyone has been in multifamily for a while or have studied, you saw the precipitous rise in prices. In valuation, we're right there with BTR. And the reasons are what we said. Multifamily itself, there's not as much community building. You're off on your own. But when you build a home for people, they're going to stay longer. You get better profile tenants. They're going to treat your property better. And that's where all the money's pouring in. If you go to any real estate conference right now, that's like the talk of the town, BTR. So if you can get into BTR, that's phenomenal. It does take more work because now you're stacking on development, which is a whole different level of skill sets. But again, you go raise capital, you go build your relationship with a team that already knows how to do development. You can get into that as well. So that's the first one, multifamily in the right area. The other thing that's kind of interesting is the triple net lease piece. I think in every portfolio, it's not sexy, but you get like a 5 to 6% cash flow that's pretty predictable. Imagine if you had a Starbucks as your tenant. Triple net lease means you don't pay property tax, you don't pay insurance, you don't pay for any maintenance. You pay for a little common area, but let's say almost all expenses are handled by the person who's leasing, the leasing. So imagine it's Starbucks. Every year they sign a 5%, a 10% increase in rent. So you close your eyes and your checks are coming in, right? It's 5%. It's not super sexy, but in any portfolio, in any healthy portfolio, you need a balance. Like you need stuff that are like
cash flowing, wealth building, tax saving.
Yeah. So I would say like those are the three areas that are super amazing.
Yes. And of course, as Palm said, our bread and butter is always multifamily apartments. We love buying something that is not built from scratch at the same time because we like to buy into profit, right? Like, so part of our healthy portfolio, we want to have that.
Yeah.
Brilliant. So we understand where the market's at, where it's going, how to get points on the board, how to avoid risk. Man, we've covered a lot of ground, but we're not done yet. The best part of the show, in my opinion, it's hard to pick a best. It's like picking your favorite kid. Not welcome to do it. We don't really do that, but it's hard to pick. But this one is very special to me. The last part of this show, I'd love to just ask you, You've clearly done a lot, and you've done a lot in 5 years. My goodness. Just from your perspective, what are 2 or 3 unfair advantages that you can give to our listeners around the world? Now, not to put on any pressure, but we're in 100 countries around the world. Tens of thousands of people every week tune into this show. What would you tell them to give them an unfair advantage so they know that your time together was well spent? What would you say?
Well, okay, first off, since it's 100 country, I'll say it in a couple countries. Hello, 你好吗? สวัสดีค่ะ. Bonjour.
Yes.
Yeah.
Yeah.
Beautiful.
And how's it going, eh? That's how we say it in Canada.
How's it going? So, okay, here's a key one. We think that leverage is the most important thing because you can always make up and leverage what you lack in skills, right? You can always in your ability. So if you don't know something, if you need a right team member, go find that person, right? And we spoke about this even offline about that helps so much more. If you don't know, or can you use some sort of tool? Can you use some sort of CRM? What tools can you use to enhance your ability to not do one-on-one? We can become one-to-many, right? What are those tools? What are time-saving tactics that we can use? What are the tax-saving tactics that we can use? Are there debt structures that we can leverage? Like all these 5 levels of leverage, if you know how to maximize all 5 levels, you can go really far, really fast because it's not dependent on your abilities.
I think you mentioned it earlier, Ryan, the ability to find a deal and find capital. If you can bridge those two, it's like an infinite return for you, but at the same time, there's no ceiling, right? And a lot of people don't get into multifamily because they think, oh, I need to have millions of dollars to buy these property myself. I don't have that. But that's actually not true. There's a lot of people who have millions of dollars that you don't have, and they're looking for people like you to put together deals to operate the deal because they want to live their life, right? So that's why it's so important to leverage because you can leverage everything. And we think that the reason why we came a little bit farther along the road is because we learned that leverage is the most important thing.
Okay. So leverage, just figure out, just think in the terms of leverage, everything that you have. How do you leverage those? Great. Number one. Number two, what would be a second unfair advantage you can give to our listeners around the world?
I think clearly pick if you're advantage in terms of profitability, right? So I would pick specifically the asset class that gives me the highest reward, lowest risk profile. So basically for us, the example we gave you, multifamily, the math is so amazing that NOI divided by cap rate is the value. Small, insignificant increases in NOI has a really massive impact. So if you want to grow fast, you pick the asset class that you feel is safe. And I don't know enough about NFTs or cryptos, so people can become billionaires overnight. I'm not smart enough to do that. If you are, good for you. But for me, I'm going to stick with the tried and true that's been around for thousands of years that people always need. As long as there's humans on earth, will need shelter. So I would pick the asset class that can give you that unfair advantage, that when you're raising money out there, you can ethically and confidently go and talk to people and know hey, this is a safe, tangible asset that is going to go up in value with inflation or better than inflation. So some of those reasons, pick the right asset.
And I think the third one is be in the room, because you can only do so much if you're just on your own. And entrepreneurship is really a lonely journey if you are not in the right room. And then when you're in the right room, you get to, there's so many doors open, right? Just through conversations, just through learning. And it's never ending education, right? You always, like we mentioned earlier, we are once you get one solution, we always solving for the next one. So once you're in the right room, when you're networked with the people who are in the same journey or just a little bit ahead of your journey, you will go so far, because whatever you think that is so small, but you see people are doing big things 10x, 1,000 times X or whatever, you're going to see oh my God, they're just the 4-minute mile. if they can do it, I can do it. And that is so important, to be in the right room.
I love that. It's often we say, I tell a lot of people, again, if you ask for advice, sometimes I'm known for giving you advice you didn't ask for, but one of the things is about getting in the right room. This is really good advice. But if I can just add to that, add my candle to your bonfire, I would say that it's one thing to get in the room, but it's an entirely different thing to be remembered that you were even there. And so, right, I remember, and maybe you made these, I don't know if it's a mistake, but maybe you didn't appreciate that second piece of advice. And I know you know this. No one gets to 300 million AUM without some people remembering or knowing their name. But getting in that right room is, sometimes it's a challenge. Because if it's too easy, it's probably not the right room, right? They take anybody. But you want to be in the room where it's a little elite. And I was at a specific event in April in Cayman Islands and met the global head of BlackRock. There was heads of the SEC and just, all great stuff. And the country leader, I believe was the prime minister or the president of Cayman Islands was there. It was a lovely event. It was amazing. Great. We got in. And it was hard to get in, but we really made sure as a team that people would be remembering that we were there. So one of our teammates just raised their hand. They're like, do you need a presenter? And they're like, actually, yeah, someone just canceled. So our whole team was represented. Yeah, exactly. So if you can get into those right rooms, but just make sure that that's step number, that's the first half. The second half is everybody took notice to the Kitti Sisters. Everybody took notice to Pentium Capital Partners or Invictus or any fund or deal that you're doing. People really need to remember and be like, how was that there? Now, I'm not saying turn it into a circus and do stupid gimmicks. That's not what any of us are saying. But what I'm saying is don't just get in the room and take a few selfies and post it on Instagram. Really get there and manage your relationships, build your business, show people that you're someone who can unwind complexities and get results. Anything you can add to that?
No,
wow.
that's exactly what we did. So we bought a deal off market.
So that's what we're going to say. It's about who, not how, right? Mm-hmm. And then it's
more than that.
It's not who do you know? It's more important who knows you, right? And that's why right. Palm was going to mention our off-market deal.
Yeah, so we bought an off-market deal. Not to bore you, but anyway, it's an off-market deal. We didn't even know who the seller was at the time. Our broker called or texted me when we were in Cabo and said, "Hey, I need your resume." And I was like, "What are you talking about?" Okay. And he said 3 hours later, he's like, "Hey, we're making a blind offer. I mean, we don't tour the property. We don't see the financials, but we're just going to guesstimate how much we're going to buy." So we gave the blind offer in. Then I found out who the seller were. And then the seller were our good friends, the same one that the Houston one. We didn't know it was him. And then, so basically, we got the deal done cheaper than his asking price by a bit. Cause we're like, "Hey, it's the Kitti Sisters. We can't make it work. Can you keep it on this price?" He's like, "Fine."
It was a buddy's.
It was like a 100K difference for him. It wasn't a big deal. And then
it was 900K.
Was it 900K?
Yeah, 100K. Yeah,
it was 100K. So fast forward a few weeks later, he was at an event. Other people, our colleagues, found out that we won the deal. They got a little bit jealous and said, how can I win deals like that with you?
How can I get that off-market deals?
And then he said, guys, this is a buddy's deal.
And I'm business with the Kitti Sisters.
And he literally said exactly what you said. This is a lesson. It's not about who you know. It's about who knows you. He knew us. He trusted us. And we exited that.
We were in the room.
Literally in the same room.
Like exactly you said, we were in the room and we were able to build a relationship with him versus other people. And then at the end, he wants to make relationship with us.
Yeah.
And even till today, we're still talking. We're still, he
is our biggest mentor in multifamily today. You have any question, any problems, you text him.
Yes.
I love that. I'll say a serious thing on that in a funny way. Horrible dad jokes. Bear with me. But I remember there was a good friend of mine, originally a mentee, and she turned into a good friend. And she said, we were all at the same event, and she was there with her husband, and he also became a good friend. And she was like, Ryan, I've never seen this. Like, these people are just flocking to you. You're surrounded. I was like, yeah, try going to the bathroom. But it's a little weird at that moment. But in all seriousness, she's like, Ryan, and this was always a saying that we always had, is this was from her, not me. So she said, Ryan, you're like the hot girl at the dance that everybody wants to dance with. So I was like, hey, that could be a thing. And so it's like, yeah, you should always try to be that hot girl at the dance that everyone's trying to get to. So when you've achieved that and you walk into a room, then you need no introduction. I'm not saying I'm anything special that way, but I'm just saying in that moment, maybe I looked cooler than I was. But the point is that you want to go in a room and people are like, oh, do you know who that is? Yeah. And so you have that reputation because you spent a career that we talked about in the beginning of building an impact. You actually care about people. You care about your investors. You care about your reputation. Their reputation is also safe with you. You care about your results and their results, and you care about the relationship. You do a lot of those things. And a lot of people are like, I can't wait to be with these people. I can't wait to do the deals. And that's why you have inbound deals. That's why I have inbound deals and investors coming to you. So before we wrap things up, final thoughts, anything else, any ways people can connect with you or learn a little bit more about you, anything at all?
Yeah. So if you're a business owner or a founder who's looking to turn your business profit into a lasting legacy through income producing asset like multifamily or new development, all you have to do is go to 1000timesbetterinvestments.com. That's 1000xbetterinvestments.com. Or the other way is if you're an experienced multifamily apartment investors, general partners who's looking to raise more money to fund your real estate deal, all you have to do is go to jumpstartapartments.com. That's jumpstartapartments.com.
Awesome. I love that. So just to wrap up everything that we talked about, just think how to leverage literally everything in your possession. That is how I started. I know we've shared, Palm, you and I, we shared the battle. So all kings and queens have their scars. And so I talked about the '08 time and how I literally had to hit the reset button, and I saw reputation, relationships, and results, and I figured out how to leverage those. So it's not just debt. It is that, but it's so much more than that. Is how can you use what you have, even if it's just a good name? How do you leverage that to get 10 times the result? That is the thinking that the Kitti Sisters have been encouraging you. So it definitely encourages on the triple R. The second one was pick the right assets. It does you no good trying to raise for offers nobody wants. So make sure that you understand your market, you understand your investors, and you mentioned structuring that offer, whether it's taxes and all that. We didn't even get into that, but saving $90 million in taxes, it's like, yeah, that's an offer people want. And so finally get in the right room, but just make sure that you are remembered that you were even there. You do these things, and you too will be well on your way in your pursuit of making billions.